Good afternoon and welcome to today's presentation, Equities and Derivatives, Essential Forensic Tools for Litigators. Before we begin our presentation today, I would like to take a few moments to go over some housekeeping items. We will be recording this webinar, and this webinar is CLE approved, and we will be asking that you enter a passcode for CLE credit a few times throughout the presentation. In today's webinar, Mr. Pines will discuss strategies for investigating and analyzing financial market data for signs of fraud or misconduct, common pitfalls that lead forensic accountants to misinterpret market data and draw false conclusions, as well as the essential toolkit for performing bulletproof financial market analysis. To give you a little background about our presenter, Larry Pines, he was an expert witness for 2 law firms in fraud litigation related to the Bernie Madoff Ponzi scheme. He is a hedge fund advisor on option strategies. Mr. Pines is a New York Stock Exchange market maker as well as an over-the-counter options trader for Chase Manhattan Bank and Bank of New York. He has also held the position of financial analyst for Lehman Brothers. For those of our attendees who require a code word for tracking purposes, the code word for today is forensic. During the presentation, we will take short breaks, and during that time, we'll ask that you enter this code into the chat feature for CLE reporting purposes. The chat feature is located to the right of your screen. Please remember that if you are applying for CLE credit, you must log on to your computer as yourself. If you have attempted to log on and received an error, or if you are listening via telephone, please email the passcode both times it is requested, and please state the time that you have entered your code in your email. Also, please remember to complete the survey that will appear on your screen at the end of the presentation. As a provider of CLE credits, we are required to have supportive information that you have attended, and in many states the survey is required. CLE certificates will be provided within 24 to 48 hours via email. Mr. Pines welcomes your questions. Please use the chat feature to submit your questions throughout the presentation. We will take intermittent breaks so that Mr. Pines can respond. Thank you all again for attending today, and Larry, the presentation is now turned over to you. Larry, are you there?
Hello, I'm sorry. Can you hear me now?
Yes, I can.
Okay. Apologize for that. Well, thanks, Emily, for that introduction, and I want to get started here and tell you a little bit about my perspective and what I bring to this subject matter. My background has been primarily as a market maker, which means essentially I watch every tick in the marketplace. I watch every nuanced move of stocks and options, and that's a little bit different than, say, somebody who has a fundamental approach, who's looking at stocks from the point of view of data such as earnings or important announcements that might affect a stock or a stock's valuation. So what that's allowed me to do is I think it brings an important perspective to the subject matter of how to look at fraud, because typically what I've seen in the past is that when something bad happens and something blows up, usually people will sort of offer their opinions of what went wrong, and sometimes we'll hear from market participants who either have a fundamental or a technical approach to the market, and they may not understand the nuances of what happened behind the scenes and sort of looking at the tick-by-tick data and what might have prevented these problems from happening in the first place. The other type of people that often are involved in sort of the post-mortem of cases of fraud are what I call the bean counters or forensic accountants who are very good at manipulating numbers, but I think often don't understand the context of those numbers. And then finally you have regulators who, to be quite frank, are just often 3 steps behind everybody else and clueless about the subject matter. So I think sort of delving into the weeds and looking at the tick-by-tick data and what that tells us about markets is an important way of approaching any type of fraud analysis. So to begin, what I want to do is just sort of talk about the 2 markets where options are primarily traded, the over-the-counter market and the listed market. Now, equities, this first chart will show you the size of the OTC derivatives market from 2007 to 2013. And what you'll notice here is that interest rate options and credit derivative options have been the biggest components of the over-the-counter market. Foreign exchange options are an important part, and equity-linked options are really a pretty small part compared to the other markets. And the reason for this is that there's been a very robust exchange market that has developed, and it's developed in a way that satisfied market participants, and it's been the primary venue for trading options has been through exchange mechanisms as opposed to over-the-counter. Now, by the way, you'll see in the little footnote on this chart that this shows notional amount of trades reported to the Bank of International Settlements, the BIS, by central counterparties. This does not measure trades that are done that are not reported, and that may be a very significant number. We don't know that, but there is increased regulations that require reporting of trades, but that number is something historically that we haven't been able to measure very well. So if you look at the size of the equity over-the-counter options market, this starts going from 2001 to the present. You can see that it kind of peaked right before the financial crisis. It reached a peak around 2007 and then leveled off, came down after that and then sort of leveled off from between 2010 and 2013. But again, this is the over-the-counter market, which for equity options, as I said, once again, has not been a significant part of trading. The next chart that I want to show you is the size of the exchange-traded equity options market. And I think here you'll see that there's been just tremendous growth in this market. And this chart only goes from 2002, but if you were to go back further to the advent of exchange-traded equity options in the late 70s, early 80s, you'll see that there's just been steady growth from the beginning, almost every year, uninterrupted growth. There was sort of an apex reached in 2011. There was a small drop from there, but it's been pretty much a steady upward growth. And as I said again, exchanges have represented an excellent place to trade equity options. They lend themselves to a standardization that some other products don't lend themselves to, and that's the reason for it. Now, I want to briefly talk about the history of the structure of markets and why that, what's happened over the last 20 or 30 years. There's been, by market participants, if you look at the equity options market, what it's often done is it's mimicked what's happened in the equity market. Options, as I'm sure many of you know, are a derivative product. Their value is derived from the value of something else, in this case, the value of equities. And in many cases, when there have been changes made in the equities market, the options market has sort of waited a year or two and then ultimately mimicked those changes. And some of those changes over the years have included things like multiple listings. I remember way back in the day, you had options that exclusively traded on only one exchange. And you can see that, without me getting into the details, the problems of that. If you have a product that only trades in one place, it's going to be ripe for abuse. If you had to go to Walmart every time you wanted to buy milk, or if you had to go to Best Buy every time you wanted to buy a computer and you had no other options, that wouldn't be a good thing. But that's what existed for many years in the options market. So you had multiple listings. You had decimalization of options where spreads contracted. Again, to make the analogy, imagine if you went to the grocery store and bought an item and it only traded in dimes. And you might say, well, so what? It's a dime versus a penny. What difference does it make? But imagine if you were buying hundreds or thousands of those items and they were always rounded up to the nearest dime. That could be a pretty expensive extra tax that you would have to pay. In addition, there's been the move from open outcry trades, where people used to scream and yell in a crowd, toward electronic trading. So there have been a number of changes, and all of these changes have been pitched as being positive, as being things that would increase improve the quality of these products. And what I'm here to say today is that in some cases that's been true, but in a lot of cases there's been other unintended consequences of these changes. And I want to get into some of those as well as we get further on into the presentation, that sometimes things aren't always as they seem on the surface. So I want to talk a little bit about fraud, and I don't want to delve too much into this because I'm not an attorney. I'm not here as an expert on every nuanced type of fraud, but as somebody who's followed markets for a long time, I'm pretty adept at understanding what sort of looking for aberrational behavior or aberrational patterns that might be indicative of fraud. So here are some examples of things that we typically think of as securities fraud: corporate misconduct, dummy corporations, internet fraud, insider trading, accounting fraud, boiler rooms, mutual fund fraud, short selling abuses, painting the tape. For those of you who don't know what that means, that's putting a trade up on the tape very late in the day, causing something to trade at a price that is either artificial or is prearranged or something to affect the final price that a security ends the day trading at. And then, of course, Ponzi schemes, which have been much in the news recently. And for purposes of this presentation, I want to focus more on the ones that are transactional in nature. So those things that involve analyzing market or trading data. So I'm not going to deal so much with things like dummy corporations or corporate misconduct or things that involve balance sheets or accounting, but I'd rather, for the purposes of this presentation, deal with things that show up in the marketplace in the form of trading data. So I want to talk next a little bit about why derivative markets represent a ripe opportunity for fraud. Now, as many of you know, there have been several high-profile cases, one of which Emily alluded to. I was involved with some cases related to the Bernie Madoff Ponzi scheme. And for those of you who aren't familiar with the details, Mr. Madoff did allege to use derivatives options as part of his trading strategy. And so have many other fraudsters over the years. They've used the options market as a way to kind of trick people who may not be familiar or who might be intimidated by the idea of what options are. And I'm here to say that options really aren't that complicated, but there have been some particulars to how the options market has developed that have led to this confusion. And I want to talk about some of those areas now. So first of all, the first thing I say here is the complexity of products. Now, the basic plain vanilla options, which are calls and puts, have become somewhat standardized, and I think they're fairly well understood, and they're really commoditized. If you look at the options markets for the most liquid stocks, they trade like water all day long, thousands of contracts, and they're valued down to the penny. They're very well understood. But there have been in the over-the-counter market more exotic products that have been developed that are maybe less well understood. And I think over time, people have come to understand that some of those products, the people who are buying them didn't really particularly understand very well. In addition, in the plain vanilla options market, there are often, or the listed market, the options that trade on exchanges, sometimes you can have multi-leg products where you're buying one option and selling another option. And that's what I'm talking about, in that the options can be put together. They can be built in a chain in a way that can create quite a bit of complexity to these products. And that always opens the opportunity for misunderstanding, for situations that can be exploited by people who don't have the best of intentions. Historical lack of transparency. What I'm referring to here is the fact that when we look at a tape that shows trades that took place in the marketplace, it's a little bit more difficult to represent those trades in the options market. And specifically, the reason for that is that options often trade in conjunction with other products. Sometimes they trade against other options products. Sometimes they trade in tandem with the underlying product to which the option product is tied. So whereas some of you might have seen a tape a transaction tape that'll show a time that a transaction took place and the price. That exists in the options market, but sometimes what that truly represents is masked by the fact that these products don't trade by themselves. So you might say, well, gee, this option traded at $5 at $9.59, when in reality it traded at $5 as a package with the underlying stock of $60. And that's an important fact, because had it traded against an underlying price that was different than that, it would affect our value of the options trade. So that's what I mean. And some of that has been corrected, if you will, by the fact that exchanges now are implementing complex order books that are showing these more complicated trades and are showing them more accurately than what they did in the past. And then finally, you have the volume of data. You have, in the listed options market, just so many strikes and so many expirations. There's just a lot of data out there. And sometimes that data can be confusing because you might have multiple, you might have a January option that trades in both 2014 and 2015, and it's very easy to mix up these symbols and think that you're trading one when in fact you're trading the other. So you have a market that's just far more complex than the simple underlying equity market, and that leads to the potential for abuse if we're not careful about how we look at this data. So what I want to talk about next are some of the strategies that we can use to think like a sleuth. And what I want to emphasize here is that a lot of the complexity of options, I kind of liken it to math, and there are certain people who have a real phobia toward math, or any subject, but that comes to mind because I think a lot of people freeze up if they have to do a calculation in their head. And similarly, I think some people who might be very comfortable talking about stocks, even market professionals, sort of shy away from the idea of talking about options because it's something that's complicated. And what I'm here to say is that if you break things down and you look at them in a logical manner and you analyze things in the context in which they appear, it doesn't have to be so intimidating or so complicated. And there's an awful lot to cover here, and there's a lot of material, and I could really only scratch the surface here, but hopefully I can introduce you to some of the ideas, some of the themes that help break down this subject into a more easily digestible subject matter. And if nothing else, it'll probe your interest and your desire to further investigate this, and either on your own or perhaps through talking to market professionals and having them offer their opinion about these subjects. So I want to begin with what I call the 5 tools for analyzing markets for possible fraud. And these are sort of the common sense pillars, if you will, that I would look at for analyzing a trading tape, analyzing a trading scenario. So we begin with transparency. And transparency is basically what it sounds like. It's, do we have all the data available to us in a way that we can understand it? And I believe, let me just see here if I missed oh no, I guess that was further ahead in the presentation, so we'll come back here. So, yeah, transparency is, as I said, it's as it's, do we have all of the information that we can look at a trade and say, what is it? Do we have the price that it traded at? Do we have the time that it took place? And do we know who traded it? Consistency. One of the tools that I like to look at is there sort of a consistency in how data is presented to us? And it's interesting. There have been a lot of studies that have done that show that as human beings and the way our minds work, that we tend to overlook repetition. So that if you present something as an advertiser, if you're looking to advertise to an audience, if you present something over and over, people tend to sort of overlook that. But people are much more critical and much more quick to jump on things that are aberrational and that look like they're out of the norm. And I think that's a principle that's important to use when we're looking at trading data, that if we see something that is aberrational, that doesn't fit into a pattern, it's then worthwhile to investigate why that is. And there may be a perfectly logical reason, and I'm certainly not here to suggest that every aberrational pattern means, aha, something's up, but it's something worth investigating. Simplicity. Sometimes the biggest problems that happen in markets, and sometimes the biggest examples of suspicious or fraudulent behavior happen when we overcomplicate things. Again, if you look at some of the biggest frauds that have been conducted, they've often taken place because very complicated confusing structures were created, and people were asked to buy into them without really being able to pick them apart and understand them. And I'm often reminded about what Warren Buffett says about investing in companies, that he likes to be able to understand in a very simple way what the company does. It's sort of being able to explain it on the back of a cocktail napkin. And the same is true of option strategies. You should be able to map them out, graph them, and understand what the end result is. Possibility versus probability. What I'm talking about here is that in the options market, you have situations where something is impossible based on the parameters, because an option is value is linked to the value of something else, an underlying, we know that there are certain bounds of what's possible and what's not possible. So a simple example, if I said to you that a stock was trading for $45 and I said, how much would you pay for a 50 level call? So in other words, that would give you the right to buy it for 50 1 month from now. And then I said, what would you pay for a 50 level call 2 months from now? Well, we know as an absolute fact that the option that has the extra month's worth of time has to be worth more than the 1 month option, because you have an extra month for something to happen to cause the stock to go above 50. So those are the sorts of tools that we can use, and that falls under the category of what I call what's possible versus what's probable. Or we might say, this is unlikely to happen, but if we can say something's impossible to happen, that raises a red flag. And then finally, context, which is, what's the context of the data that we're looking at? Can we look at it in a way that makes sense? And I can think of a myriad of examples of this where I've worked on data that other forensic accountants have looked at, and they haven't looked at it in the proper context. They've analyzed a lot of numbers, not understanding that these numbers represented something different than what they were actually looking at. So we'll move forward, and I call this section the tail of the tape. And what I'm talking about here is sort of being able to look at a ticker tape, much like the one that's represented on the screen, and be able to sort of pick things apart to figure out what's going on and what's represented by the examples. So we'll move forward from here, and here's what I call my transparency bugaboos, and these are the things that should create some level of suspicion when we're looking at markets if we can't effectively analyze these component parts. So the first one is price. We should be able to see what the price is of the security that we're trading. And you might say, well, of course. But the market structure now has evolved in a way that isn't always the case. And I'm going to talk about in the next slide something called dark pools, which has received a lot of attention in the media, and it's received a lot of scrutiny, and it's been the subject of a lot of controversy. But the idea is that there is now in the equity market a number of off-market trades that take place. And there are different types of these dark pools, but essentially they're entities that trade away from the marketplace and away from the structure of the marketplace. These trades are ultimately reported on what they call the consolidated tape, which shows you all transactions, but they're reported later, so that's a significant fact. So they're not available, although they might have taken place sometime before they're actually reported. They don't get reported to other market participants until, and it depends on the market, but they're reported sometime later. They're reported as over-the-counter trades, and we often don't know who participated and took part in these trades. So this, again, is a development that was supposed to improve markets, and in some ways it has, but it also represents an opportunity for problems if we don't follow through on why something happened. And again, time and place is when did the trade take place and where did it take place. If we look at the over-the-counter market, we often see trades that happen where we don't know who transacted the trade. You'll see often in the options market, in the listed options market, a trade will take place and we know who the broker was that executed the trade, and we know who the counter broker was, the other broker was, who took the other side of the trade. But in the over-the-counter market, that's not always the case. And there are specifically a type of over-the-counter trade that can take place where two participants can transact an options trade, and they can do so under the cloak of anonymity. And they can do so by using the broker as a middleman, so that each side only knows that they're interacting with a broker, and they don't actually know who the other side was for that trade. So these are accommodations that were done to ensure that there's the opportunity for anonymity, but it represents a problem as well, because it does take away from transparency. And that's the last point about counterparties, which is that we want to know who it is that executed the trade. So anytime we don't have this information, it does represent a problem. And this is a problem that's increasingly a part of the market structure. And and I'm about to talk about dark pools now, while dark pools have not yet really infiltrated the options market in any significant way. There are some examples of limited dark pools. Right now, they represent about 40% of all equity volume for stocks. And that is expected to, as I said, because most things that start out in the equities market eventually migrate over to the options market. I would expect at some point that would show up in the options market as well. The paradox of liquidity. So, quote here from the Dalai Lama: "A lack of transparency results in distrust and a deep sense of insecurity." And we generally think that we need liquidity to have transparency. But I'm here to tell you that that's not often the case. And here is my quote, which is, "Liquidity can mask transparency and create right conditions for fraud." So what I want to do now is show you these individuals, and you may recognize who they are, and I call them, members of, among many others, but members of the Hall of Fame fraudsters. And you've got Bernie Madoff, you have Alan Sanford, another Ponzi scheme participant, and you have Bernard Evers, who is the chairman of WorldCom, who used his stock in WorldCom as a tool, basically, for engaging in massive fraudulent accounting and enriching himself, as well as inflating the value of his stock. And what all of these individuals have in common is that they all use very liquid instruments for engaging in their fraud. Now, in the case of Bernie Madoff, he used the S&P 100, or what we call the OEX contract, as the tool for his Ponzi scheme, what he alleged to be trading. In the case of Alan Sanford, it was CDs, certificates of deposit. And in the case of Bernie Evers, he used WorldCom stock, which was one of the most liquidly traded stocks of the time. And I think what this points out is that there's often this misperception that frauds only take place in pink sheet securities and illiquid securities, and I'm here to say that that's just not the case, that very often it's easier to hide fraud in very liquid instruments. And I think the sophistication of people who want to do ill will has advanced to where they're able to use these instruments as a way of doing some harmful things. So what I said is they're all hiding in a crowd, but all of these fraudsters used very liquid instruments where it was very difficult to decide from when and where they were actually in the marketplace trading, and that allowed them to say that they were executing very large trades, and it allowed them to expand the size of their frauds without it becoming apparent to the marketplace. So I think we're at the point where we were going to take some questions from the audience about where we started, the topics that I covered here to start, and if anybody has anything, I'm happy to take them at this point, or if we want to move forward, we can handle them later on in the presentation.
Okay, and before we begin the question and answer segment, could all the attendees please type the passcode into the chat feature? Okay, our first question is there a tip-off or clue, so to speak, that would indicate that the potential of fraud could exist what records could be most valuable to try and determine if there is fraud?
Well, this is a difficult question to answer because there's so many types of fraud, and in a broad sense, if you're, we talked in this last little segment about Ponzi schemes. These were cases, and I can touch on that if that's helpful. But these are falsified records that were used in the case of Madoff and Stanford, where statements were sent out to people that were inaccurate. And as far as tip-offs, we tend to look for things that don't seem plausible. So that could be anything from market data that doesn't add up, that doesn't look right. One thing we can do is we could look at the consolidated tape, and we could look at ranges, and we could actually look at when and where a security traded at a given time. And if we see that, as an example, if on a given day 100,000 shares of this stock traded on a range between 70 and 71, and 5,000 shares traded 71, and our fraudster says that they trade, or the suspected fraudster says they traded 5,000 shares at 71, well, how plausible is it that they traded all the shares at the very highest price of the day? In this case, let's say they said they were selling 5,000 shares at the highest price of the day. So there are a number of tools, but we look for, and I think we'll get into some more of those a little bit further on when I look at some examples from the options market. But anything that doesn't look plausible, that seems extreme or exaggerated, certainly not. Obviously, well, there are two things. We could see something that's impossible, or we could see something that's improbable. If we see something impossible, then we certainly have a problem on our hands. If we see something improbable, then obviously we want to investigate further.
Okay, our next question is, how are dark pools used to trade in the listed options markets?
They're not, to this time, they're used on a very limited basis. There are different kinds of dark pools. There are some that are run by institutions, such as banks, for the use of their customers. Brokerage firms and banks will allow their customers to meet in this dark pool to transact business. And then there are others that are offered by pseudo exchanges, if you will. And there's only a couple right now that are offered on a very limited basis to customers to use, and it really hasn't developed into a big part of the options market yet. Although the characteristics are in place, because as long as you have large volumes and liquidity, there's going to be an interest in using dark pools, and specifically when you have market participants who don't want to show their hand. But to answer your question, it has not been used in any great way in the options market yet. It's used, as I said, it represents 40% of the volume now in the equities market, and most market participants believe it's only a matter of time. But right now there are only two exchanges or pseudo exchanges, exchange-like mechanisms that operate dark pools right now in the options market.
Okay, those are all the questions we have for now, so please continue with the presentation.
Okay, sure. So when I was talking about liquidity and its ability to mask things, I sort of put together two tapes, if you will. In the first one I have AT&T, or symbol T, trades 20 million shares, and the other one is made up symbol XYZX that only trades 150,000 shares. And when you look at a stock tape, you'll see in the left column a time the transaction took place. In the middle column, you'll see a price at which the transaction took place. And in the right column, you'll see the number of shares that are traded. And as you can see, if we look at the example on the left, a 10,000 share print in a stock that trades 20 million shares, 2 cents above the last trade, because if you see here, let me go down this took place at 35, oops, let's see if we can get color that works, versus the last trade at 34.98, we wouldn't really find this to be all that suspicious. So it's possible that here this looks like it went up at 16:04, which would be 4:04, 4 minutes after the close. We wouldn't likely look at this and say that there's anything really to stand out as being suspicious. Whereas if we look at this tape here, where it looks like the final print went from 24.92 down to 24.90 and was 2,400 shares, which in a stock that only trades 150,000 shares, this might actually be a fairly decent-sized print that represents, you know, a bigger share of the volume than, I believe, than what we could look at it here, than the 10,000 shares would in a 20 million share traded stock. So, then we have this print that goes up, then we see at 16:01, 1,821 shares, and then all of a sudden we see a 10,000 share print go up 13 cents above the last trade of 24.92. So it goes up at 25.05. And this can mean a lot of things, but one of the important things when we look at this data that we want to understand is where did this trade, and was it reported as part of the range of trades on the day? And sometimes, and this is something that's important to understand, is that sometimes trades that take place in third-party markets or markets that aren't considered major markets don't show up in what we call the consolidated range of trading on the day. So this trade may or may not show up, but it's something that we want to understand. And if we see this happen periodically in a stock where we see large prints going up shortly after the close, this could be something that is worth investigating. It might be somebody who has a position on their books and they're looking to make the actual price of the stock look higher than where it actually traded on the day. So these are the sorts of things that we look at as traders, is how much of an aberration is the print from the last trade that took place. Now, this might in fact be a legitimate trade. It's not necessarily that something suspicious or funny is happening here, but if we see this repeatedly, if we see a pattern of this, it's worth looking at. It's very possible that somebody came into the market and needed to buy 10,000 shares, and that drove the price up this additional 13 cents. But you could see where the same size trade in a stock that trades a multiple of that in terms of volume is a lot less likely to be noticed than it is in a stock that only trades a fraction of that volume. So my point, I guess, in bringing this up is just to be aware that it's easy sometimes to manipulate stocks or options that have very little volume, and it's something that if we see a pattern of that, it might be indicative of somebody trying to paint the tape, if you will, or make something look like it's trading at a better price than it actually is. And this is frequently done. This is done quite a bit by funds at the end of quarters where they have a position and it can be done much more easily in a stock where there isn't a lot of trading volume. So they can actually, if you had a position of several million shares, you might happily buy 10,000 extra shares on the close to make your position look like it closed at a higher price than it actually did. So that's an example of where one stock being very liquid, the other stock being more illiquid, and how it's more easy to manipulate the less liquid stock. I want to talk next about consistency. So these are what I would call the red flags, broad red flags for there not being consistency in markets. One example, a big discrepancy in what we call option premium from one month to the next. So if we have and we'll go through an example of this, but if we have a stock where we see that the options generally trade at a certain spread, and then all of a sudden that spread expands, that might be indicative of something going on in the marketplace. And it could be an event that got leaked, and we'll look at an example of that. And what I'm talking about here is, let's say we have a month of May. I'll use my pencil again, a month of June. And we know that every month, let's say the May out of the money calls versus the June out of the money calls trades for $0.25, meaning that the June option is 25 cents higher than the May option. Well, let's say all of a sudden that spread starts to widen. It goes from 25 cents to 30 to 35 to 40. All of a sudden it's doubled to 50 cents. Well, and let's say in addition to that, we don't know of anything going on in June. Let's say the earnings are in fact in May. Well, it's very likely that something is going on in June. And very often these events show up in the options marketplace long before they ever get publicly announced. And these are examples of insider trading where you'll see a spread between 2 months expand because an event gets leaked. Another example of that, and we'll go through specific examples of these later, is when you have market skew go from puts to calls. And what can happen here is that, let's say in this example, we know that we have a stock that's, let's erase this. We have a stock that's $25. And I said to you, what are the 30 calls worth and what are the 35 calls worth? Well, generally what happens in the market is that the market prices puts more than calls. And this is somewhat counterintuitive to explain. But what happens is that in most stocks, there's an expectation that they take what I call the stairs up and the elevator down. That we expect that most stocks are going to make very gradual incremental increases over time, but that all it takes is that one bit of bad news and the bottom falls out. But when you have a stock that's involved in a takeover, the behavior is a little bit different. And what happens is, in takeover stocks, we see that the calls trade at a premium to the puts. So that if a stock's trading 30, and all of a sudden we see the 35 calls getting bid up to a much higher level than the 25 puts, even though each option is $5 away, that may mean that there's some expectation that a company is going to get taken over. And we'll talk about that as well later. And then finally, reversal conversion values out of line. And what I mean by this is that there's a mathematical relationship between where calls and puts should trade relative to the price of a stock. And the easiest way to think of it is that if you buy a call and you sell a put that's struck at the same level, that's a synthetic way of buying the stock. It's equivalent to buying the stock. So there should be a mathematical relationship between that and the price of the stock. But if what happens is that that price keeps getting driven down, what that means is that the stock can't be borrowed, so that people who want to short the stock instead are using the options market because they're unable to do that through the conventional means of selling the stock. So we'll go through an example of that as well. So when an event gets leaked, so here's a case study example. We have a company, Cancer, biotech, developing a cancer drug and awaiting FDA approval. Well, if we look here, so I set up some options where we have a strike price, we have a bid, we have an ask, and we have a delta, which is basically a percentage chance of this option ending up in the money. And if we started to see a pattern where we want to look at these options, these out-of-the-money options in each month. And right now, as I said in my example before, let's say the spread is 25 cents between these. But let's say that this option, we're seeing 5,000 contracts trade. So let's say this option went from 35 cents, and all of a sudden it was trading 50 cents. And then we know that this option can't trade for less than 50 cents, right? So let's say it stopped going up. Let's say it stayed at around 50 cents or 55 cents to where what we call the time spread between this and this went to almost zero. Well, that's a certain sign that somebody believes that the company is going to get taken over in March, and that this April option, nobody would pay extra for it because once it's taken over, let's say it's going to get taken over for a price that's just over $35 a share. Well, once that happens, unless another bidder were to come in and pay higher, nobody would really want to own these options. So looking at time spreads is a very good way for what I call the spread between 1 month, in this case March and April, or it might be between March and May. But looking at the relative values of those spreads is a great way to look for some type of news getting leaked into the marketplace about an event that's going to happen. And I don't want to spend too much time in this because we have a lot of other subjects to cover, but I'd be happy to take questions on that later on in the presentation. When skew gets flipped. So here we have a case study. We call this company Foamy Insulation Maker. They're rumored to be in play. So several insulation companies are interested suitors. So when I say what happens when skew gets flipped, in this case, so I put up call options and put options. It's the other example we just had the call options. So let's say we look at these calls here, the June 40 level calls, and the stock is 33, and then we look at these here. Well, the stock is only $3.23 away from the price of 30, and it's $6 and 77 cents away from 40. So even though it's further away, we see that these options are worth more. And we might say, well, why is that? And then if we look at the next month, that's not the case over here. That over here, these are worth more. Well, what the market might be telling us again is that there's an expectation of something that's going to happen here in this month. So looking at these patterns where normally we expect, because these are closer to 33, and we know that most stocks, as I said, gradually move up and plummet when they go down. We would expect these to be worth more. But this could be an example of where the market's telling us that there's some likelihood of a takeover. And if we want to start doing a forensic analysis after the fact, we could go back and look and say, well, who was buying these options? Was it one brokerage firm? And then we could even take it a step further and say, were there recommendations being put out by that firm? Were they positive on the stock? Were they perhaps front-running an event that was occurring? But these are the sort of tools of looking at the relationship between these strikes and then going a little bit further to doing additional research, which could yield some clues about what's happening. So why are the calls higher than the puts in that previous example? Well, possible takeover, as I said. That's certainly something we have to think about. We want to look out for front running. Is somebody actually moving ahead and doing something because they know some information that hasn't shown up in the marketplace yet? And orders, as I said, often show up in the options market first, and that's a clue that something's going on. When the whole world wants to be short, in this case study, Fancy, a clothing company. They developed a social network for people to share links to pants they're wearing. Company has no revenues and market value of the company at $10 billion. We've probably all heard that story before. Here, we want to look at what the value of what we call the combo is. So we have a strike of 20, and we have a price for the calls and a price for the puts. And we would expect that if we took the call and we subtracted the puts from it, that we would arrive at a price that should be around $20. But if we do it in this case, we come up with 172. I'm doing my math correctly here. And if we add that to 20, we see 2172, which is below the current price of 2224. Something doesn't add up here. Why is somebody willing to sell me the stock via the options at a price significantly less? The reason is the stock's probably going lower, and somebody can't short the stock. And if you try to buy it and hedge yourself by shorting the stock, your stock may eventually get called in because the stock's unable to be shorted because there's no stock available to borrow. Once again, this could be an example of front running and somebody knowing something and it's showing up in the options market first. So moving ahead here, I want to talk about simplicity now. Why do you have to go and make things so complicated? This guy has 20 monitors to trade SPY, which is the S&P 500 Exchange-Traded fund. if something looks too complicated and somebody can't explain it to you, something probably doesn't add up. And I've seen this time and time again, where, you know, if somebody can't explain a strategy to you in a way that's understandable, you probably don't want to be involved in it. I had a hedge fund pitch to me once an idea about analyzing volatility using some complex algorithms. I tried to pick it apart and understand it. They were claiming that they had the opportunity to make fractions of a penny doing this. It didn't add up. It didn't make sense. Usually when it doesn't make sense, there's a good reason for that. And again, this is an example of where somebody could take a very simple trade and make it look more complicated than it is. If you were to short a stock, let's say at 32.50, sell it short, buy a call and sell a put, that's essentially a hedge trade. It's a neutral trade. And I use the example here, you know, 2 plus 2 equals 1 plus 1 plus 1. We could just say 4 equals 4 and make it a lot simpler. And sometimes we could use options to make riskless trades but make them sound more complicated than they are. And that's really my point here, is that because options are often used in tandem with other options, they can appear more complicated than they are in reality. Complexity red flags. So this is something I want to spend a little bit of time on. Customized options. Anytime somebody is using customized options, which exchanges now allow quite a bit of flexibility in using these, it's important. It's a good time and it's a good place to ask, you know, why do you need this customized option? Very often they're more difficult to look up the price of customized options. They can also trade in the over-the-counter market, but we understand that in the over-the-counter market we're dealing with more sophisticated players who probably know what they're getting into. So customized options, and by that I mean instead of trading a June 50 call, which expires the third week of June at $50, somebody says they want to trade a June 12th call struck at 50.27. Sorry about my messy handwriting. There may be a legitimate reason for this, but anytime something is customized, it might also be a red flag that somebody's trying to maybe make it more difficult to accurately obtain the price of that option. Maybe they're hoping somebody makes a mistake in pricing it. I've seen situations where these trades are mispriced by market makers who don't realize that there's a different date involved, and there ends up being out trades or errors as a result of that. Complex structures. Anytime you start building one option on top of another option, there's the potential for problems with that. And it's something to be aware of, that the more complex the trade is, you better really pick it apart and understand what you're looking at. And then cross-product hedging, which is when you have one option on a stock, let's say trading against a completely different security. So maybe somebody's trading options on the S&P 500, but they're hedging them with options in the gold index or the treasury bond index. And again, these instruments may be correlated, but it's worth asking, why is somebody doing this, and does this make sense? Possibility versus probability. So options have walls. One of my posters from one of my favorite movies, Office Space. If you haven't seen it, go rent it or find it. It's a classic, iconic office movie. But the idea here is that options have bounds on them, where there's limits to what something can be worth. And we talked about it before in terms of calendar spreads, where I know if I have more time, an option has to be worth more than something with less time. If I have an option, if let's say I have a stock that's $40, I know that the June 45 call has to be worth more than the June 50 call, because it's only $5 away and this is $10 away. So using those arbitrage principles are just a good way to figure out if something passes the eye test, if it makes sense. Arbitrage found. So one of the arbitrage bounds is parity, which is the difference between the strike and the underlying price. So if we have a strike of 25 and an underlying price of 30, parity is $5. It's premium, which is how much we pay above parity for an option. Calendars, which is what I was talking about before, that something with more time has to be worth more than something with less time. Strikes is same as what I was talking about with parity. A strike that's closer in the money has to be worth more than one further away. And then correlated instruments. What is something worth if it's relative to something else that it's correlated with? So let's say we have options on the SPX versus options on the Russell index or the OEX index. We can look at those correlations and make some intelligent comments about what something's worth relative to something else. So these are some examples. I went through option walls. This is a formula, sort of a basic formula for looking at the value of a call and the value of a put. So we know that a call value has to be equal to parity, which is the difference between the strike and the underlying price. Then we can add the value of the put. We can add interest, and we can subtract the dividend. So in this case, parity for the 95 call is $5. The put is $1, so that would be $6. We know that the interest is a quarter. That's 6 1/4. The dividend is 35 cents. So we can sort of say approximately this call should be worth $5.90. And we could use these principles to kind of, again, pass the eye test of what makes sense when it comes to valuations. I want to delve into this subject, why free sites can be a headache. There's a lot of information out there in the internet now, and there's a lot of free sites, and most of them are very good. I mean, there's Yahoo Finance, there's Google Finance. I use those all the time, but you have to be really careful about how you interpret this data. And I think this section is important, and let's try to get through it, and then we'll get to some questions. What are some of the pitfalls of looking at historical data? Well, one of the things that we can encounter are stock splits. And when we have a stock split, it suddenly changes the amount of volume that's getting reported in the marketplace. Corporate events, similarly, if we have and I'm going to get to an example of these as well. Corporate events, when something happens that affects the number of shares that are outstanding. It could be a buyback. It could be some event that affects the number of shares outstanding. Pre-market and after-market data. Do we report it? Are we looking at data that trades before the market opens at 9:30 or after the market closes at 4 o'clock? So stock splits. We'll get to that subject. Here's an example. So we have symbol ABC. Price is trading for $30 a share. It trades an average daily volume of 13 million shares. Well, ABC now does a 2-for-1 stock split, and now it trades for $15. Well, the number of shares are going to go up to 26 million. So if we're going back and looking at historical data, it's really important that we know how that's being accounted for. And unfortunately, from using a lot of the free sites out there, I've seen that there's real discrepancies in how this data gets treated. Sometimes it is adjusted for, and other times it's not. And then when it's not, it could suddenly appear that there's a huge surge in the amount of volume. So if we're doing studies for a case that you might be working on, or some type of litigation where we're looking at volume that traded in the marketplace and whether certain trades were plausible or not, it's really important to know whether or not these adjustments in volume are taking place. And if they're not taking place and we're not making those adjustments, then the data that we're looking at is bad data. So this is why it's really important to have somebody who's doing this, who understands the context in which they're looking at this data, and isn't just taking a bunch of data and crunching numbers without knowing that something happened here, in this case, a stock split. Case of mistaken identity. The man on the left is John Wayne. The man on the right is notorious serial killer John Wayne Gacy. So the reason I bring this up is that there was a famous politician, I'm not going to get into names, who appeared in the town where John Wayne Gacy was from and said, I'm here to visit your town and honor the great legacy of John Wayne. And obviously that didn't go too well. So, and the similar names, the cause of that difficulty. So why do I bring this up? Here's an example, and this is something that that I dealt with myself on a case that I was working on, a very similar example to this. So we have Huge Bank Incorporated, symbol HBANK, and the HBANK's price is trading for $40. They make a play to buy Megabank, price trading for $50. So H-Bank is going to offer 1.5 shares of its stock for each share of Megabank. So Megabank's price, as soon as HBNK makes that offer, is going to go to what? It's going to go to probably about $60 a share. So after the merger, though, they decide, Huge Bank does, that Megabank has a much better brand name. It has more tellers around the country. It's better known. So they're going to go ahead and they're going to use Megabank's symbol. So the company is going to be called Megabank afterwards. Well, what happens now when we go back and we're looking at historical data on the stock? So Huge Bank becomes Megabank. So the date that this happens, let's say it's here, going forward, every time we look up Megabank's price, we're going to actually be getting the price of the new entity, which is this stock. So all of this stock, all the prices going forward would actually reflect the fact, because H-Bank now took over the name Megabank. So H-Bank is now called Megabank. So going forward, every time we look up Megabank, we're going to be getting this price showing up. But going back before then, if we look this up, what are we getting? Good question. Do we want to look at the old Megabank, or do we smooth it out and say, well, this is when the merger happened, but prior to that it was called H-Bank, but it's the same company. So it's really important that we know what it is that we're actually looking at. If we want to look at this stock, which ceased to exist on this date, that's different than looking at historical data for this stock. And I worked on a case where I had a forensic accountant make that error and look at data that they claimed was for the other company, the acquiring company, not for the company that was acquired, and that created a big error in the data that they were looking at. So sometimes just pulling a bunch of numbers is no substitute for actually digging into the data and seeing what it is you actually have. Pre-market and aftermarket data. Really important that we know when we're looking at a series of data whether or not the pre-market data is being included in the consolidated tape of prices. So let's say you have some news that comes out before the market and a whole bunch of trades happen. At the end of the day, when we're looking at the overall volume, are those trades being included or are they not? And the same goes for aftermarket data. If we have an earnings announcement after the market, is that data being included in the prices? Since we know that prices trade after the official close of business on the day. Good free and paid sources, Bloomberg, Reuters, corporate websites, Yahoo Finance and Google Finance. All of these are things that are decent tools, but there's no single one of these tools that's going to provide all the answers. Options Metrics is great. The SIBO website has a plethora of data about options that are really useful. LiveVol is a professional site that's designed for professional options traders. iVolatility.com as well. These are all sources for sort of digging into historical options data, volatility data to show movement in the marketplace as well as historical prices. And then painting the tape, this was similar to what I talked about before, but if you have a stock, or not in this case an option, where it only trades on one floor, and we see these are the markets between the bid and the ask, if all of a sudden at the end of the day we go from having this 5-cent and 10-cent wide market, 140, 150, 140, to 150, 180, and then all of a sudden it trades at 180, we have to ask ourselves, why did this happen? And there may be a very good explanation. This would only happen if it only traded on one exchange. And believe it or not, there still are some options that, because they're not particularly well popular or well regarded, they only trade on one exchange. In a normal close, we wouldn't see that. We would see the normal 5 or 10 cent wide spread. So this is a sort of forensic analysis that you want to do if you really want to dig into what's going on in the marketplace. Open interest plays, real quickly, I'll go over this, is when a stock's about to announce when a stock's about to go ex-dividend, meaning it's about to pay out its dividend, there's a way to trade large numbers of contracts to capture the possibility of earning that dividend. And sometimes you'll see tremendous volume go up in options that are an exercise, and it's a way of capturing that dividend for people who forget to exercise. And this is something that you'll see happening. It's a perfectly legal, legitimate play to make. You'll see it happen in stocks that are about to as I said, to go ex-dividend, and it creates a tremendous increase in volume, but it's not volume that's actually being transacted for purposes of hedging or speculation. It's options volume that's taking place in order to capture a dividend that's coming out of the marketplace. Finally, context, putting it all together. Again, the thing I would emphasize most is that when you look at data, you want to look at it in the context. So my example with the H Bank and Mega Bank, you want to know, what is the data that I'm looking at? Why is it appearing where it is? What does it say about, is it an accurate reflection of the security that I'm looking at, or is it a reflection of something else? So context is really important. Understanding when we see discrepancies, as I mentioned, between calls and puts, why is that happening? Is it expectations of a takeover? Is it expectations of an event that's about to be leaked into the marketplace? And I think if you don't look at things in context, you can easily end up drawing some false conclusions about what's going on. So context is important. Looking at things in relation to other pieces of information, looking at options in relation to equities and where they trade, these are all important tools. And I know we're running a little short on time, so I'll open it up to questions now.
Okay, then we're going to move on to the second Q&A. So could all the attendees please type the passcode once again to the chat feature? Okay, we have one question. How do parties anonymously trade in the OTC market? Okay,
it's a good question. There are methods that can be used by brokerage firms to facilitate that. And what ends up happening is you have a broker that'll transact a trade. A broker will find somebody with an interest. An interest meaning they want to buy $5 million of euro calls on the dollar, let's say, and struck at X level. Then they find somebody else who wants to sell that. The brokerage firm that's executing the order will first execute a trade with the buying party in which they would sell. They would then go to the party that wanted to sell, and they would buy it from them. And then they would simply pass the names of the two parties to each other. So what ends up happening, or rather, they would pass the trade on to each other. So what happens is, let's see if I can explain that a little bit better. The brokerage firm sells to the buyer and buys from the seller. They then pass the details of that trade along with the brokerage firm as the counterparty for that trade to each side. So the side that buys will know the brokerage firm as the seller. The side that sells knows the brokerage firm as the buyer, and each side will eventually be responsible for the obligation to the other party in which they which had the original interest of the trade.
Okay, those are all the questions we have, so thank you very much for answering that.
Okay.
This webinar is eligible for CLE credit in California, Illinois, Missouri, New Jersey, Pennsylvania, and Texas. To ensure that you receive your CLE credit, please complete the survey at the end of the presentation. This is a reminder that the CLE certificates will be provided within 24 to 48 hours via email. And in addition to being your best source for testifying and consulting experts, TASA also offers e-discovery and document management solutions, free interactive webinars, and research reports on expert witnesses such as the Challenge History Report 2.0, the Professional Sanction Search, and the Expert Profile 360. I want to take this opportunity to thank everyone for attending, and most especially Larry Pine for his time and effort in creating this presentation. If you would like to speak with Mr. Pines, or if you would like to speak with a TASA representative regarding an expert witness for a case that you are working on, please contact TASA at 1-800-523-2319. This is a reminder that we will be sending out a link to you tomorrow with the archive recording. The archive recording will also be posted in the Knowledge Center on TASA's website. If you have any questions or comments, please email Carol Kowaleski. Thank you all again for attending, and have a good day, everyone.